We're here to talk about the Silicon Valley real estate market ending the week of September the 26th, presented on Saturday morning, the 27th of September. These are the chapters we're going over to. The timestamps are in the descriptions below. I have changed the order slightly. Let's get into the first data slide. Here, what we're looking at is a summary of some key indicators. We're looking at inventory. The middle of the table is this current week. Then you go back for 13 weeks, which is a full quarter, and you go forward for 13 weeks. On the going forward, the only thing I have is trend data. I don't have the actual raw data because it hasn't happened yet. But what you're seeing right now is with inventory, we're just slightly above the normal level of inventory. Higher level of inventory than normal favors the buyer, which is why the blue line up here is blue. Blue favors a nice cold buyer's market. Red favors a red hot seller's marketplace. They're defined by the red is the case of inventory is the 10 percentile level of inventory. The blue is the 90 percentile of inventory. And the gray is the typical, the median. So we're having just about the normal level of inventory. You can see the percentage level here is 4% more inventory than you expect. A quarter ago, we were at 16% more inventory. So the inventory level has come down. And as far as those that want raw count, it's 2799. So basically 2,800 listings. And if you want the raw numbers for the hot marketplace, the typical marketplace, and the cool marketplace, they're over there for you to look at. Doing the same exact thing with number of offers. Now you'll notice the blue is on the bottom and the red's on the top. And that's because a lot of offers favors the seller and few offers favors the buyer. And as you can see right now, we are close to the favoring the buyer line. We have fewer than expected number of transactions. We only have 87% of the transactions we normally have. Now, if you've been following me for any length of time, you know that's getting to be better because we were at 25% and then we were 20 and now we're about 15% missing as offers accepted, but it's slowly improving. And by the time frame, we're going all the way back to 2022. So these improvements are long-term slow improvements. And part of that is sellers are locked into low interest rates at 3%. So it takes a bigger incentive to get them to move. You also have a lot of people moved with the pandemic. So that pulled some of those buyers forward into the 2021, 2022 years that we had. Moving on to simply the number of transactions. Transactions are closed transactions. These are offers accepted. They may fail. Once they fail, they no longer count as an offer accepted. So an offer accepted is one that's accepted that eventually successfully closes, or at least it's still in escrow. So number of transactions, you can see they're right on the top of the blue line. We're at 80% of the number of transactions you normally have. That is what the real estate industry runs on. That's just 1,950 roughly number of transactions in the last 5 weeks. So you can see that the number of offers accepted is higher, and part of that is failure ratio. And part of that is you can see the number of offers that's been going up recently. And so that will take time to be reflected in the number of closed transactions. Days of unsold inventory is sort of a theoretical number. It's a turnover rate. It's a supply-demand balance. You can see earlier this year, earlier this quarter, and it's a moving quarter, we were above the blue line. So you were slower than you would expect based on the past 10 years of data. Now you can see basically starting about 5 weeks ago, you started dramatically improving. And then, you stayed midway between the blue and the gray line for a while. In the last 2.5, 3 weeks, you've been down here almost on the gray line. This week and last week, you were right on the gray line. The week before that, 2 weeks ago, would have been sort of halfway in between. So right now, the speed of the marketplace, the turnover rate of the marketplace, the pressure the buyers are feeling out there as far as how many people are at open houses and stuff of that nature is exactly normal. And in Silicon Valley, that is a fast-paced marketplace. But basically, we'd sold our total inventory in 45 days, and you can see it's 45.5 days. Typical is 45, so we're only a half day longer. Nobody's in a sense that difference. The quickest marketplace we've had at this time of the year is 26 days. The slowest we've had it is 50. So you can see the difference between the typical marketplace and the slowest is very tight. It's only 10%, but going from the typical to the quickest is half. So it's not a linear distribution, and that's why the red line is so much further below and the gray and the blue line are fairly close together. What it does say is we have hot years, but we rarely have a cold year. We rarely have a year where the market is slower than typical. Moving on to the next one, it's just related but similar, but yet different, is marketing time. How long does it take for 3 out of 4 sellers that are successful in accepting an offer? In their case, the buyer's successful in getting it accepted. The seller accepts the buyer's offer. 75%, 3/4 of your sellers are selling in 29 days. But look at this improvement. So, it's not a huge improvement. Here you were at 30, you slowed down a little bit, but notice how marked that is at a time when the gray line is basically flat or slightly increasing. The blue line is normally going up. So we've had a fairly significant departure just in the last week on marketing time. Now, it may be a fluke, but what that's saying is 3 out of 4 sellers are selling faster. You can see a quarter ago, we were at 175%, so almost double our marketing time. Now we're only 16%. So we are slower than we typically are. But what are we talking about? Typical is 25 days. We're now at 29 days. For 3 out of 4 sellers to sell in for just 4 weeks, 28 days is 4 weeks. So call it 4 weeks. That's under a month. That's fairly quick paced. Now let's look at price reductions. These are price reductions that the seller takes to get the buyer to come in. We were taking double the price reductions a quarter ago, 13 weeks back, but only 1.3%, 1.4%. So it's a small price reduction, but that just shows you how little price reduction Silicon Valley typically has. Why? Sellers do their homework before they go on the marketplace. It's a fast-paced marketplace. There's a lack of supply constantly in this valley. And so the price reductions sellers have to do are fairly normal. There's also a tendency for a small fraction of the marketplace to do the bulk of the price reductions. Now you can see that you've had the same magnitude of price reduction. In fact, it went up a little bit. It's 0.02% greater, but call it identical. But look at your percentage. So now you're only 53% the larger price reductions, and that's because the market normally is taking larger price reductions. Therefore, when you stay at the same magnitude, you've reduced your percentage. In other words, the blue line, well, actually, it's the gray line that determines it. So the gray line has sloped down from here 13 weeks ago to present day. It's maybe doesn't look like it. It looks to me like maybe the bottom was right about here, then it sort of went up and came back down again. But the price reductions are typically more common at this time of the year, and therefore the percentage of normal has been reduced. But you can see that typical is only 0.9% price reduction. So we're taking almost 0.5%, almost 50%. Well, we're taking 53% bigger price reductions than we normally do. Then finally, we're talking about overbidding. Overbidding is not a leading indicator. I put it on here because it's a metric of interest. It's a lagging indicator because the offer has to get accepted, the offer has to get closed, and then we have to have the data reported. So what you're looking at is normal overbidding is 7.4%. 13 weeks ago, we were only at 4.6%. So you were getting less overbidding than normal, but now we're getting a little closer. The overbidding that we're getting is 4%. Typical overbidding is 5.1%. So we're only 1% off. Here, you're almost 3 full percentage points off. Here, you're only 1% off of what normal is. Now we're looking at the 3 key indicators over long term. The first one is the purple line, the inventory. You can see that we're 4% more inventory than normal. You can see earlier this year, you had this big bubble of surplus inventory, but it's clearly gone away. You've had another big bubble back here at the end of 2018, 2019, but this is the second highest level of inventory that we've had, and we've cleared it out. And now we're basically only 4% more inventory than you normally expect. Then moving on to offers accepted in the orange line, you can see that here we're about 87%, it looks like to me. I think the number I said earlier was 84, and I'll look into that small discrepancy, and it may be my memory, but basically you're about 87% of the normal level of offers accepted. So offers accepted are coming back. You can see those 30% missing that we were talking about here in 2023. In 2024, we were missing about 20%. And now we were missing only 10% here. Then we went all the way down to 25%, then back up to 10%, 25%, 20%. And now we're down to about 15% of the marketplace being missing. So we're still missing a chunk of the marketplace, but long term, this orange line has been slowly improving, and it's not a straight line by any, it improved, then it was probably flat for a little bit, and it looks like it was just improved. Well, it's really improved dramatically in the last couple of weeks, and the last half of the quarter. But have to sort of balance where do you think that's going, and we've already turned around, so we may be coming back down. But the general trend is a slight improvement, or at the very least flat, and I think that's being pessimistic. So I think there's been an increase in the number of offers. And lastly, we're talking about the gray line, the speed of the marketplace, and here you can see that we're almost exactly normal. Now you might say, Richard, how can you have normal inventory, be missing 15% of the marketplace, and have almost normal speed of the marketplace? The 3 metrics are looked at individually. So the median of the 3 metrics are happening in different years. It's not they all happen in the same year. If you happen in the same year, the DUI in this case would actually have to be slower because you have fewer transactions. But because they're having in different years, I'm comparing each metric to itself, not finding the median year and then looking at the numbers. Now we're going to jump and look at the micro market. And I decided to do this give you an overview of what's happening in Silicon Valley, and then get into the micro market areas, because I firmly believe micro market areas are what's important. Because right off the bat here, you can see that Half Moon Bay has 40% more inventory than it typically does, and Campbell, Cambrian, Santa Clara, Willow Glen has 17% less inventory than it normally does. So to paint those two different geographical areas in the same statistic is simply wrong and inaccurate, in my opinion. So here is the actual numbers for Silicon Valley up at the top, Santa Clara, and then the micro markets in Santa Clara County, San Mateo and the micro markets in San Mateo County, Alameda County, and then the micro markets in Alameda County. And for Alameda County, I don't have actual individual data for the first couple slides. This to me is what the key is, because if you're looking to buy or looking to sell or just trying to figure out what's going on in East San Jose, for example, is different than what's happening in Santa Clara, which is different than what's happening over here on the San Mateo County coast. That's why I moved this up. This is now looking at the offers. Offers you can see across the board is pretty much blue in color, which would say fewer offers, but now there's some notable exceptions. Los Altos Palo Alto has 23% more offers than it typically does. So maybe it's stock driven, maybe it's just coincidences. Then Redwood City's got 21% more. Everybody else is pretty much below 100%. There's a couple right in San Mateo County at 100, but Alameda County overall is at 82%. Most of Santa Clara counties, except for the Los Altos that I pointed out, is below 80%, 85% or below. Then moving on to speed of the marketplace, days of unsold inventory. And again, I'm comparing this to the same week. Blue is going to be favoring the buyer. A slower market favors the buyer, so that's going to be a higher DUI. So in East San Jose, you're 33% slower than you normally are. Days of unsold inventory is 33%, a third longer than it normally is. But now if you go up into Los Altos and Palo Alto, it's at 71%. So it's actually faster. So the Los Altos market is faster right now than it typically is. And I'll point out too that Cupertino Sunnyvale is at 5%. So it's essentially normal. But in a second here, we'll see that that's still fairly fast. We'll go right to Cupertino at 26 days. It's one of the fastest numbers. So even though it's slower by 5% than it normally is, it's going to sell out the entire inventory at 26 days. And, it's not the fastest, because Redwood Shores, which realistically is a very small number, so it fluctuates quite a bit. So I would say that Cupertino Sunnyvale is the absolute fastest marketplace on the turnover rate it's measurable, that's statistically significant, but it's actually 5% slower than it normally is. So those are the kinds of nuances that I think are important. You go down to South County and you're at 53 days. So you're double the time of Cupertino Sunnyvale. East San Jose, the affordable areas are double the time. But now they're neutral in color. But, here you have Milpitas, 31 days, and it's still red in color. Why is it red in color? Because that's still a fast-paced marketplace. Anything under about 6 weeks, 42 days is, in my book, a fast marketplace. But now look over in Pleasanton, Dublin, and Livermore. That's a very slow area. You're talking 113 days for Pleasanton and then 133 days for Livermore and Dublin and Castro Valley. And that's why it's so deep blue, it's a very slow marketplace. So you can go from a red hot marketplace to a deep marketplace all within Silicon Valley at the same time. Moving on to days on market. This is that 3 out of 4 sellers. How long is it taking to sell? Look at Saratoga Las Gatas. It's 40% of the time that it normally takes. So it's selling in less than half the time. Now, that time may turn out to be long or it may turn out to be reasonable, but Saratoga Las Gatas is normally a slower marketplace. Now, when you come down to Alameda County, and I do have the micro market data, so you can start seeing the fluctuations, 37% slower in Pleasanton, 6% faster in Berkeley, 68% slower in Hayward. So most of Alameda County is slower than normal, which is a higher days on marketplace. So you can see overall the county is 130%, and it's the fastest. San Mateo's next at 110, and almost normal is Santa Clara County at 104%. And because of Santa Clara and Alameda, your average for the whole Silicon Valley is at 9%, but there's a big difference between 9%, 4%, 10%, and 30%. So again, that's why I think micro market data is so important. Moving on to the real raw count, and I think with Saratoga Las Gatas, it was by far the fastest compared to normal, but it's actually a little bit slower than Cupertino. So Cupertino, I think, was 5% longer. Saratoga Las Gatas was 40% of what it normally is for this time of the year, but their actual marketing time is essentially the same at 12 and 13 days. So basically your fast raw numbers are right here. This is where the market's really fast, and those are the more expensive areas. Some of the outlying areas are blue in color, except, there's exceptions to that. You come up here to Menlo Park and Atherton, the very expensive areas in San Mateo County, and it's blue in color as well. So again, I'm just trying to stress the importance of understanding real estate as very local investment opportunities for people. Here's price reductions. This is where the sellers are taking the largest price reductions compared to what they normally do. So you can see where they're taking price reductions and where they're not. So Saratoga is taking less price reductions than they normally do, but by 4%, 2% in Los Altos. And these are very small numbers. And I'm going to go back and dig into my database because I'm not sure I have a good handle on this. 5% doesn't sound like much, but that's my saturated red. My saturated red is at 2.75%. So I clearly expect this to be a fairly tight metric. Here is what those ask price reductions are, and these are average. So you can see that they go from about 1.7% or 1.6% price reductions in Santa Clara County and Milpitas to a price increase of 0.1% in Cupertino. In San Mateo County, 0.4% increase in Foster City to 3.4% price reduction in Atherton, or if you want to do it in a more reasonable area, 2.8% on the coast. So wide distribution within the same county. Alameda County is closer together and taking fairly significant price reductions, going all the way from 1.5%, which is actually Berkeley down here at 0.6%, but most of the areas there are around 2%. The average is 1.75%. That's price reductions. Frequency of price reductions. How common is price reductions compared to normal? And so it's 10% more common in Silicon Valley. Santa Clara County is right at normal at 99%. But now come down and look at Cupertino, Saratoga, Los Gatos, and even Los Altos, Palo Alto. They're at half of what they normally are doing in price reductions. So the expense of the west side of the Silicon Valley right now, sellers aren't doing price reductions. The buyers are coming in, buying, selling quickly. There's apparently an unmet demand in the more expensive, more affluent areas of the valley as we speak. Then you go to San Mateo County and this, the expensive areas. Obviously, it's quite a bit more expensive than Atherton, Menlo Park, well, especially Atherton and Portola Valley, than it is in Saratoga, Los Gatos. It's a completely different marketplace. Saratoga, Los Gatos is faster, less price reductions, and Atherton, it's more. And you go to the coast, it's way more. But then you go to Redwood City and it's less. You go down to Hayward, it's double, and you go down to Berkeley, which is ask price frequency of the price reduction. So we talked about, compared to normal, but what's the magnitude? It's less than 1 in 4 sellers in Santa Clara County, and that's actually, considered slow. Let's look at Saratoga, Los Gatos. Only 1 in 10 sellers is doing a price reduction. Cupertino, 1 in 20 sellers is doing a price reduction in Cupertino and Sunnyvale. It's 1 in 20 for Foster City as well. And again, that's a small area. In Berkeley and Alameda, it's 1 in 20. So price reductions in those areas are almost unheard of. But then you go to like Castro Valley and it's 1/3, and even Pleasanton is 1/3. Hayward is a little slightly higher than 1/3. So you go from 1 in 20 to 1 in 3. I mean, that's not even in the same ballpark in my book. Here's overbidding. This is the competition that the buyers are feeling. Now, remember, this is what the market was 5 weeks ago, not what the market is today. And this is compared to normal. So basically, there's less overbidding than there normally is for this time of the year. And again, that's a snapshot in the rearview mirror. But now what you look at what those numbers are, it's still overbidding by 3 and 4%. So 3 and 4% overbidding is less overbidding than we normally have. You can see Silicon Valley overall is 4%. Santa Clara County is at 2.9%. San Mateo is at 3.1%. And Alameda County, that's the slowest county probably by bar none, has the most overbidding at 5.6%. That's because the sellers are coming on the marketplace, overestimating the marketplace, doing a price reduction, but then they're overestimating their price reduction. And the buyers are coming in and go, we don't care this property's been on the market at 30 days. The new price is resetting the marketplace, and it's now a great buy. So we're going to overbid the seller's ask price, even though it's been reduced. So this is overbidding from the price at the time the offer was accepted, not from the original list price. This is the frequency of overbidding compared to normal. So you can see, without a doubt, for the vast majority of the area, the one exception is the coast, which is unusual because it's been pretty slow. The amount of overbidding is way less than you expect. You can see that it's not so less on the sort of the affluent west sides that we're talking about. We're doing well, but overall, there's less frequent overbidding than you would expect for this time of the year. But what's the magnitude of the overbidding? It's still strong overbidding. I mean, 75% of the sellers are getting more than their asking price. 50%, you have to go down to Morgan Hill to get to 1 in 3 sellers are getting more than their asking price. So you have to keep in mind, we get used to a norm here in Silicon Valley, And that's why I'm doing the 10-year comparison. So you see where we normally are, but then you have to come back and say, what does that really mean? Because you look at this graph and you might go, oh, overbidding doesn't happen. Everything's blue. It's a ice cold buyer's marketplace. Well, come over here and the raw numbers still tell you that half the buyers are overbidding. So that half the buyers overbidding is a cool marketplace says something about how superheated we normally are. Here's the long-term appreciation of the different areas. You can see that Santa Clara County has done 101%, 102%, but notice that not a single micro market area in Santa Clara County is at 100%. How do you explain that? These affluent, expensive areas of Santa Clara County are selling a bigger market share than they normally are, which pulls up the median price. That means when you hear the median price quoted in the paper, that isn't necessarily property values, because when you have a market shift and you're selling more expensive homes all of a sudden, that raises the median price without raising property values. And you can see that San Mateo County across the board has done less appreciation, and I firmly believe that that's related to the pandemic. The desirability of living in San Mateo County decreased with the amount of remote working that happened, and Santa Clara was still reasonably close and more affordable, and it's got the highest appreciation rate. And even in the micro market areas, because if you did a weighted average of these numbers here, you might come up with something like 90%. You come down to San Mateo County, and you're probably going to get some number closer to 60%. And you go down to Alameda County, and you're probably going to get a number closer to 65% or something of that order. Now, instead of following just the median number, which is this number in the middle, sort of a column, it's all done by my computer macros. So when you have only 3 digits, it doesn't move over far enough. But, basically that's the median. The number to the left is the cheapest 10 percentile. The number to the right is the most expensive 90 percentile. So 80% of the homes in any given area are between the outer lying numbers. 40% is between the number on the left and the middle, and 40% is between the number in the middle and the middle number on the right. Here's a summary. Here, instead of alternating, I grouped all the 10-year comparisons. So you can see overall with some exceptions, and the exceptions are basically the affluent areas of Santa Clara County, Cupertino through Palo Alto. Most of the area is blue. So most of the Silicon Valley is slower than normal. But even though it's slower than normal, you come over here, and for the most part, those are fairly good numbers. So even though we're slower than normal, we're still fairly robust. And the overbidding is in orange because it's the lagging indicator. And you can see that you still have a fairly aggressive overbidding. And then you have simply the appreciation here. And you can clearly see Santa Clara County's got the best appreciation. And then you have the price, which is simply, which are the more expensive areas, which are sort of in the middle of the table, just the way that's laid out. And then the more affordable areas on the top and the bottom. Now we're looking at Silicon Valley as a whole. We're looking at each component over time so you can see what's going on. This happens to be inventory. You can see right now you're above the normal level of inventory. We're climbing. It looks like we're about ready to roll over. We're not quite there. We're probably closer to the red line, and we'll roll over and start coming down later this year. Now, anything can and does happen, but the tendency of this decrease at the end of the year during fourth quarter is very, very strong. Here's looking at on a percentage basis, so you can see inventory is about 4% more inventory than you would expect for this time of the year. So essentially normal inventory. You can see you're pretty close to the gray line. You can see that for once we had the pandemic, which is basically right here, we've been living in this shortage of inventory. Then we had the surplus earlier this year. So to be close to normal level of inventory is a nice. Offers accepted, we're still on the low side. You can see it too is about ready to roll over like inventory. And again, this tendency for falling down is very strong at the end of the year, especially once you get past Halloween. Here's on a percentage basis. So you can see we're somewhere around 87% of the offers you'd expect, and still in what I would call cool marketplace inventory or offers. Days unsold inventory, the ratio. Now here, we're almost normal. See how close the purple line is to the gray line? So we've, and in Silicon Valley, a normal marketplace is a fast-paced marketplace. So we're no longer up here where we're slower than we typically are, or even slower than we are most of the years out of the last 10. Now you're almost right back. And look how quickly it happened. You had a big downturn, which was probably the holiday Labor Day, and back up. So the trend is basically, straight down since, maybe 3 quarters at the end of July, beginning of August. This would have been July 1st right here on the gray line. So you're a couple weeks past July 1st. So here's the DUI compared to the 10-year median, and you can see that we're right at the normal level. So the speed of the marketplace now is exactly typical for the past 10 years. You can see the improvement over the last couple weeks. Here's the days on marketplace. Notice the huge drop. We dropped from basically 34 days to sell 3 out of 4 sellers and down to 29 days. So that's a 5-day improvement. Any property that sold in less than 29 days would have helped drop that number. So what it's saying is in the last 5 weeks, we had a lot more homes sell in under 29 days than we did in the week number 6 through 2 to 6 weeks ago. So it was either last week, a whole bunch of listings sold, or 6 weeks ago, a whole bunch of long listings sold. You can see that it was level for a long period of time, but to have that kind of drop is pretty significant. Then when you look back, yes, there's changes in it, but I'm not seeing any time when the purple dramatically improved that much when the gray line was going in the other direction. The closest example is right here, but the change is only like 2 days, where the difference over here is closer to 4 days, if not 5. So I'm not seeing any time when you had a 5-day drop in 1 week at a time when the market's normally going up. Here's the days on market compared to typical. We dropped from basically 40% longer than normal to now only about 15% longer than normal. So that's a fairly significant improvement on a percentage basis as well as the raw count number. This is the price reductions, the largest 10%. So the sellers that are taking the biggest price reductions now are taking a 14% price reduction. That is significant, 14%. The reason the number 1.4 or 1.6 is so small is the vast majority of the sellers make no price adjustments whatsoever. You can see that, again, there was a huge improvement with reduced pricing this last week compared to normal. So it's still 25, 30, or closer to 30% more sellers are taking a larger price reduction. So that's the 14% price reduction is 30% more than it normally is. Here now is looking at the seller's average price reduction. So this is where that 14% becomes 1.4, because you're adding in a whole bunch of sellers that take no price reduction whatsoever. But you can see there was a huge improvement. Now, in a cool marketplace, there is normally an improvement right at this week, which is interesting. In a normal marketplace, there is not that improvement. So the fact that we improved is not that dramatically unexpected, because when you're close to the blue line, you expect it to perform more like the blue line. As you get close to the gray line, you expect it to perform more like the gray line. And when you're close to the red line, you expect it to perform more like the red line. This now is the average compared to normal. So we are still taking about a 12% larger price reductions than normal on average. So this is everybody included, those that don't take price reductions. This is the frequency. So how common is the price reduction? We're at 18%. So less than 1 in 5 sellers do a price reduction. It typically dips down right at this time every year. You can see it's consistent on all 3 markets. This is the frequency compared to normal. So we're taking 20% more price reductions than we typically are. It's sort of almost a little confusing, because I think the number was close to 20% of the sellers are doing a price reduction. And now it's that 20% of the sellers are doing a price reduction is 20% more than normal. So normally the number is somewhere around 16%. So 20% of 16% is an extra 4%. If I'm doing my math right, actually, it's only another 3%. So it's about 16.5%. Normal price reduction. Now it's 20%, and that's 16.5 to 20% is a 20% increase. This now looking at the magnitude of overbidding. So this is a rear view mirror indicator. You can see we've improved a little bit, but we're still just half of 1% overbid on average on median. So that means half the buyers are bidding more than 0.5% above, and half are bidding less than 0.5% above. And that could include people at asking price and below asking price. Here you can see that we're 1% below the typical overbid, and this is the magnitude of overbidding. So if the overbidding is typically 5%, we're now only at 4%. This is the frequency of overbidding. You can see that something like 54% of the buyers are overbidding the seller's ask price. You can see the increase in the last couple of weeks. And again, this rear view mirror indicator because of the delay to get escrows to close. Here's on a percentage basis. You're basically only selling, you're only about 85%, 82, 84, 83, about 83% of the sellers, the buyers that normally overbid are overbidding. So 17% more buyers are not overbidding at the moment. This is a pricing model. The 11.4% straight through is getting pretty outdated. It really misses the mark for the latter part of the run up that we've had. It also is now quite a bit off the current pricing, where if you change it and say we've got 12.1% increase for 7.5 years, and the last 3 years it's been totally flat, that's actually a fairly accurate modeling. Yes, it's inaccurate right through here because we did have a little dip in property values, but it's also an end of the year mix, so it was accented because at the end of every year you have a decrease in the median price, but that's not a decrease in property values to that extent. To some degree it is, but it's mostly a market mix issue. So this was a combination of property values and market mix going down, but we basically came up and we've been flat for the last 3 years. Now I'm breaking down and comparing the 3 counties individually. Alameda County is in the gray here, and Santa Clara County is in the blue, and San Mateo County is in the orange. So you can see inventory is coming down, but flat for the last week. Offers accepted, fairly level. Santa Clara County is doing more offers with less inventory. So it's got the fastest speed of the marketplace, the days unsold inventory, followed by San Mateo County. And Alameda County is the slowest, but yet remember it had the most overbidding. Marketing time, the longest marketing time in Alameda County. Santa Clara and San Mateo County very close together at 26 days. Price reductions, the most price reductions, because coming down is larger price reductions. This will be 2%. So Alameda County is about 1.75%. San Mateo County is about 1.25%, and Santa Clara County is about 1.8% price reductions. This is the frequency. Alameda County the most frequent. San Mateo and Santa Clara County tied. Now here's the overbidding. Notice Alameda County that looks really bad until you get to overbidding. It's got the most overbidding, and I've explained already why that is. But it's got 5.5% overbidding, way outperforming either Santa Clara County or San Mateo, which outperform Alameda on marketing time. Here's the overbid frequency, very close together on all 3 counties. Here's the long-term appreciation. Santa Clara County doing the best. San Mateo and Alameda County essentially copying each other. Here's the price. San Mateo County is the most expensive currently. Santa Clara is next, and Alameda is the more affordable area. Here's the same information on regular paper, where you can actually read the numbers a little easier. And here's the estimated payments using the high balance conforming loan limit at 80%. You would get lower rate by just doing a jumbo loan like most people do, or if you qualify for relationship pricing with your bank and stock portfolios. And these are the chapters we went over. The first was a recap of all of them, then the summary, then the long term, then the micro market areas and the summary, Silicon Valley as a whole, and then the 3 counties compared to one another. And then finally, how to participate in the market meeting. And we'll get into that right here. This has been the Silicon Valley Real Estate Marketplace. We'll come back and do the distributions. We will then after that do the Greater Bay Area. The YouTube channel is here in the blue. Shorter typing is the green root URL. To get to the presentation Saturday morning at 9 a.m., you type in the green root URL in the year 2025, or you can type in the longer Zoom link if you want, and the meeting code's up there too if it asks for it. The handout's up there. If you try to get to it, it only went up about a minute before 9 o'clock. So to get the handout, you type in the green root URL, the letter H for handout, the year 2025, the month 09, and the date 27, or you can type in the longer Google Drive, but that's from a couple weeks ago. I'm not updating that link every week, so sorry about that. If you really want to have the handouts and you don't want to use the green root URL because it's a secondary link, send me an email and I would be happy to send you the current long link. Now we'll finish up with Silicon Valley real estate market. We'll do the distributions. This is days on market. So now we're going to be able to maybe see the improvement, but we start off a year ago on the dotted line. The purple line is the current year. So you can see the market is cooler this year than it was last year across all price points. Let's step into it. You can see you're really not moving anywhere. You're just bouncing around. This typically happens every year. Now you're starting to slow down. There's a major slowdown, another major slowdown. There's the slowest of the marketplace on December 27th. Now you're improving. Right coming up there is the fastest the market got, which is on February 21st. Now the market's already drifting down. So the market it improves dramatically and then it's slowing down fairly quickly. You can see we've been just slowly going down. And about here, we're going to be bouncing now for quite a bit. But we're also going to now improve at the very end. You can see there's not been much movement for the last several weeks. But now watch from this green line to the purple line. So just in case you didn't see it, go back to the green line and onto the purple line. So there was a drop in the days on marketplace, and it was basically through this whole segment of the marketplace. It's not happening down on the 50 percentile because they're all real close together, but it's happening on the 60 through the almost 90th percentile. So that 30% of the marketplace really decreased the days on market overall. Now doing the same thing on the sellers that are taking the largest price reductions. And the reason I say that is I go all the way up to the sellers that are taking the 97.5 percentile sellers, and I only go down to the sellers that are at 82.5%. So it's only that upper echelon, the upper, not less than a quadrant. I drop off the top 2.5% for data entry errors, and I drop off the 17.5% because you can see a lot of times you're at zero. Now, right now you're not at zero, but I sort of have to hedge my bet on what I include and don't include. So we're same concept. We're starting off a year ago on the dotted line, current's the purple line. So you can see you're taking much larger price reductions this year on the purple line than we were last year. But the last year data will tell you which way you expect the market to go. So really not much in the way of changes. Now you're cooling off at the end of the year. And that's the coolest right there, December 27th. Look at that dramatic improvement, another one. And there's the peak on February 21st. Now you're improving. Now you're really slow, not improving, but slowing down. Now you're basically almost unchanged from now until current. Well, right there. So, we've slowed down quite a bit, but once we slow down, we really it's not gone anywhere. And now what's going to happen? We're improving. And one more. And so is that two improving? So there's an improvement and there's an improvement. So we've improved the last 2 weeks on price reductions. So sellers are taking less price reductions, but we're still taking significantly more price reductions than we were a year ago. Third and final distribution is buyers overbidding. And again, this is a lagging indicator. So the market, these indicators are going to happen about 5 weeks after the market peaks. Now, in a hot marketplace, escrows tend to shrink to about 3 weeks, and in a slow marketplace, they tend to expand to 5 and 6 weeks. So the delay time frame isn't even the same, and if you really pay attention, you might notice that. So we're starting off a year ago on the dotted line. Purple is the current, which is clearly smaller price overbidding. Now, at the top end here, it's actually the same and maybe a little bit better this year. So the very extreme, those that are basically somewhere around 10% and up, the buyers that are overbidding the top 10% are overbidding more this year than they did last year, but that's only a small segment of the marketplace. It's only 10% of the marketplace. Anyway, let's step through. You can see there's really not much movement, a little bit of improvement, but not much. Now it's very stable, a little slow down, step down, another step down, another step down. That was the bottom of the market on January 24th. So the bottom of the marketplace on the other, and there's the peak of the marketplace right there on March 8th and 22nd. So probably right there on March 15th that we don't have the data for was probably the peak. And now there really isn't much movement. Look at how little movement there is. Yes, there is movement every week. There's the bottom of the market again. And now we're going to turn around and actually improve a little bit, a little bit, a little bit, a little bit, and no change. So even the overbidding has been improving a little bit the last couple of weeks. And that would have been the last couple of weeks plus a delay of about 5 weeks. Here's the raw counts. Now notice we actually now are the fourth best year out of the last 10. So there's 3 years that were worse. 2023 at 1861, and this number of offers accepted. 2024 at 2,083. 2022 at 2,099. And this year we're at 2159. So we're 60 listings more offers accepted. Now this number will decrease and may catch a couple of these years, but for right now, we're having the best we've had in a long time. Yeah, right up here 13 weeks ago, we were at the fourth best year, and we're now again at the fourth best year, and we're also the fifth best year out of the last 25 years. So that's getting to be more centric, less extreme. All these times when we were the second worst year out of the last 10 years and the second worst year out of the last 25, that becomes noteworthy. We're clearly improving a little bit on as far as offers coming in the door. Here's the raw counts, whether you're interested in Silicon Valley, Santa Clara County, San Mateo County, or Alameda County. I also have the median, average, and 75th percentile here all grouped together so you can see the differences. You can start seeing the difference in the 75th percentile. Santa Clara County, 75% of sellers sell in 28 days. It's taking 38 days, almost a third longer in Alameda County. Now we're moving on to the Greater Bay Area. That's going to be Silicon Valley that we've talked about, and also San Francisco and Marin, which is the cities, the North Bay, 4 counties, Central Valley, 2 counties, and the Central Coast, Santa Cruz and Monterey being 2 counties. Here's the active inventory. You can see inventory sort of rolling over in all 5 regions. There's no big increase in any region. They're either flat or going down. And if you look back in time, you can see that market normally has less and less inventory just about this time of the year. So that would be the trend going forward, most likely. Offers accepted. Look at the increase. It's a little bit in Santa Cruz, Monterey, Central Coast. It's a fairly significant increase in the city. Flat in the Central Valley. Fairly significant increase in the North Bay, and an increase in flat in Silicon Valley. So the buyers are coming back. The number of offers are increasing a little bit. Days of unsold inventory, the speed of the marketplace. Notice a decrease in basically every city. Silicon Valley is actually the lowest and the least improvement, but look at the city's improvement. I mean, it went from 70 days down to 50 days. That's a 20-day improvement in 2 weeks, maybe, because it looks like there's one data point right about there and then one down here. Look at the improvement in the Central Valley. It's gone from something around 105 days down to 80 days. That's an improvement of 25 days in just way under a week, 13 weeks. And look at North Bay. It's gone from basically 115 days down to 82 days. Look at Central Coast. We went from 107 days down to 90 days. So there's a huge improvement in days unsold inventory, and improvement is from the seller's perspective. It's decreasing. The market's getting quicker pace. From a buyer's point of view, this is not what a buyer wants. A buyer wants slower turnover. Here's marketing time. Now you can clearly see they're not related, because even though they seem to be more related logically, look at North Bay. It's actually increasing. Central Coast is up from 2 weeks ago, but down from last week. Central Valley is flat, but now look at the cities. A huge improvement in the cities and the huge improvement that we've talked about in Silicon Valley. So the areas that are centric to the high tech have improved. They've dropped their marketing time for 3 out of 4 sellers. The other areas are basically slowing down. Here's the price reductions that the seller takes before the offer come in. You can see Central Coast is taking the most price reductions. It's just over 3.25%. The North Bay is next at about 2.75%. Then Central Valley at 2.2%, and the cities in Silicon Valley identical at 1.4% price reductions by the seller before their offer comes in. Here's the frequency of sellers doing price reductions. Most common in Central Valley, where 2 out of 5 sellers is doing a price reduction in the Central Valley, close to 2 out of 5 in both the North Bay and the Central Coast. But then you come down to the cities in Silicon Valley, and it's less than 1 out of 5. So less than half the number of sellers are doing price reductions in the areas that are really the heart of Silicon Valley. Here's your overbidding. This is at the time the offer comes in. Cities has the most overbidding at almost 8%. Silicon Valley is next at 4%. The other 3 regions are all below 100%. That means that on average, the buyers are coming in below the seller's ask price in North Bay, Central Valley, and in the Central Coast. Now here's the overbidding, the most overbidding in the cities and then Silicon Valley, and that's above 50%. Everybody else is right around on both sides of 30%, so significant difference there. Almost half the overbidding as far as frequency. So it's way less common when you get out of Silicon Valley and the cities and you're looking in the North Bay, Central Valley, or Central Coast. Here's the long-term appreciation. The cities continues to have the least appreciation. North Bay is second, and then the other 3 are fairly close together. Look at the huge drop in Central Coast. That is likely the smallness of the data set and also the market mix. If you're selling all 1 week along the coast and the next week along the 101 corridor, there's a huge difference in value. In this doesn't necessarily mean prices, and it doesn't necessarily mean appreciation. It shows you the inconsistencies and the issues using median price when you don't have a homogeneous characteristic marketplace. Here's the price. You can see that the most expensive area is the city in the orange, followed by Silicon Valley in the purple, Central Coast on the blue, North Bay, and the most affordable being the Central Valley. You can come back and look at the horizontal. A lot of these areas started reaching these prices way back here in 2021, and that really starts showing you the flat performance. Let's look at the Central Valley. It popped up here in 2022, just before the market correction, and then you dip down, but basically it's flat. Yes, it came up and it reached its new level, but it's been basically flat. Silicon Valley and cities fluctuates more. It's more volatile. It seems the closer you are. It's almost like the stock market volatility comes over into our real estate market volatility. Here's the payments, assuming a 30-year fixed high balance conforming loan limit. So if you get a jumbo loan, which most people in Silicon Valley do, your payments would be lower. Also, if you're fortunate enough to have leftover assets to get relationship pricing with the bank, that lowers those payments as well. Here's the actual data. You have the current raw data under the now column, percent change from a week ago and percent change from 5 weeks ago. So you can see that inventory is up from a week ago, but it's down from 5 weeks ago. We have been talking about the Silicon Valley real estate market. These are the chapter descriptions that are in the YouTube description below. We start off with a summary of Silicon Valley, and we get into the micro market areas, which is what I think is pivotal for making decisions. Then we do a recap of Silicon Valley, the different metrics long term. Then we get into the 3 counties, how they perform against each other, how to participate in the presentation on Saturday morning, and how to get the handouts and PowerPoints. Then 3 distributions of Silicon Valley, then the raw data. And then we finally get into the Northern California, 5 regions, 13 counties, and end the presentation with a quick recap. So I've been Richard Calhoun, Creekside Realty. We're willing to work with buyers or sellers here in Silicon Valley. Reach out if you have any comments about my statistical presentation or want any real estate questions answered. Thanks. Bye for now.